Recipes for technical trading success in Cook's Kitchen.
Is it 1998 all over again? And where will the market bottom? Let's go to the charts and see what we can learn here. All right. S&P 500, I'm just going to go from the top down with important things that you want to pay attention to. I'm working with a new miniature keyboard here, so bear with me. And I just advanced my slide. Let's try that again. So, looking at the RSI, you can see how often does the S&P get over 70% on the RSI? It's definitely an overbought signal there. And we just bounced off of 30, so that's encouraging. Now let's get down to the price action here. 1980 was a big level for me. Why? Because that is roughly the tops back here in the summer, and then it was support in the fall around the 1980 level, so that's why I took in some longs there. Very important to me. This market could still come down and test the 200-day, which would also be about the 50% retracement of this whole move from the October lows up here to the D's highs. So something else to pay attention to there. MACD is still down here, is still rolling over, saying we're in a downtrend. So now let's get a little macro. I've been writing this week that investors are sitting on their hands. Why? Because if a country is in trouble, it means probably a few hedge funds are in trouble too. So nobody's in a huge hurry to grab the longs that I thought they would around S&P 2000. And that's exactly what's going on this week. Sort of waiting for the other shoe to drop with a country or two in trouble, and who knows how many hedge funds who love to buy that emerging market debt and those equities are also in trouble. Sort of best to stand aside and let the chips fall and then pick up the bargains. But definitely, if the seasonal is going to hold true this year, this is the time to buy here down below S&P 2000 in December with the VIX above 20. It sets up a good buying opportunity. All right, let's look at some other charts that aren't quite as promising. Here's the Russell 2000. Looking at the IWM, what did we have? To me, this was waiting to go higher, this 5-6 week consolidation, and we busted through the bottom of it on the fourth try. Now, does that mean it's broken? Not necessarily, because I see two scenarios here that I outlined for my folks last week. The first scenario is you could just break down through, have sort of a flush and a bear trap that stays above 110, 111 on the IWM, and then we can make new highs next year. That scenario could still unfold. The other scenario is, hey, it just keeps going, and we threaten the October lows. So we're still set up for a possible scenario number two, where we hold, say, 112, and then the S&P recovers, Russell goes with it. So those are my two scenarios for the Russell. What you're going to start hearing people talk about is the golden cross. Remember the death cross? 50 crosses below the 200-day back in early October. Well, guess what? We're setting up here. We now have a bullish golden cross, 50 over the 200 in the Russell. All right, next we're going to look at the NYSE, New York Stock Exchange Composite Index, because it is such a macrocosm, if you will, of the whole market, because it includes so many stocks, and it forewarned us of the correction in September, and it may have just made a triple top now. So let's go right there. So here's the NYSE. You see you got your triple top, June, early September, now November, and could not even make a new high, could not touch 11,100 like it did in September. So very bearish. Now this big slide here, I mean the NYSE was breaking down. You saw it in the small caps, you saw it in the mid caps. It was creeping into the energy space. Then, I just advanced my slide again. Let's go back here. Now the energy trade has gotten worse, and that's why the NYSE is getting hit so hard. There's its death cross, 50 under the 200. Not that it really matters, but this index is indicative of the pain in the market across many sectors, many market caps, etc. RSI might have a chance for a good bounce here. All right, next we're going to talk about the Hindenburg Omen. Now, there are many variations of it, and we've seen dozens of Hindenburg Omens in the past 2 years that were supposed to send the market tail spinning lower. So let's just talk about what it is real quick. Actually, I have it all queued up on a slide here, and I will just read to you. The Hindenburg Omen identifies market action where there are a large percentage of both new highs and new lows in very close proximity, often in the same day. On December 1st and 8th, both new highs and new lows exceeded 7.5% of total issues on the NYSE. That's a big number, 7.5% for both of them. This is indicative of market turmoil. The VIX was not high then, but internal market violence was. All right, that's my description. I wrote that, so if anybody wants to write in, they've got a better definition of the Hindenburg Omen with all the exact details. I don't care. This is what I'm making the general description of what it is. Lots of new highs, lots of new lows at the same time as a percentage of the index, and it's in the past it's signaled bad times for the market ahead. So now let's go to I want to show you a study that Dana Lyons did over at J. Lyons Fund Management. So he says, okay, forget the name Hindenburg Omen. So he just crunched some numbers, and he noted here, you can see December 1st and 8th, he's got up here with 7.5% of total issues were both making new highs and new lows. And how often has this happened? Well, he had to broaden it out because that's only occurred 3 times since 1970. We had two this month, then 1 in 2008, so only 3 occurrences since 1970. So he lowered the bar a little bit, lowered the threshold. How about greater than 4% of total issues for new highs, new lows, 27 times since 1970. What are the results? Go down here to his table. They're all red going out 6 months, meaning what were your returns after this? After 3 days, after a week, after a month, after 6 months, the market was always down. After a year, just advance my slide again. After a year, the market was actually up, but not much. So, and how many times did you have positive returns? Hanging around 25 to 35% was the most you can expect to get positive returns after this event. So, these are just statistics, right? But we use them, we say, how might the future be like the past given these conditions? And this is not, this is not curve fitting here. We're just looking at a simple thing of when there's a lot of market turmoil, a lot of new highs and a lot of new lows at the same time. Now, as I discussed on the webinar last week, the way I explained this was that what's going on? Well, so many energy names are getting decimated. The whole sector is getting decimated. So that's why you have hundreds and hundreds of new lows at the same time you're having new highs in a bull market, as you should. So one part of the market is normal, lots of new highs in a bull market, near the highs, and one thing is a problem, all those new lows. And it's not just energy, but primarily that's why we're getting this so-called Hindenburg Omen so much. All right, I hope that's clear. Let's move on here. Let's try and find some optimism and look at possible signs of a bottom. This was my big indicator for the bottom in October. This is the S&P 500, so the S&P 1500 rather. So it's the 500, it's the mid-cap 400, and it's the small-cap 600. 1,500 stocks, looking at high-low percent. So this is another way of looking at the advanced decline data. And what did we get coming into October? I was looking to exceed this minus 5% area, and boy, did we ever. We got down here to 10% a couple of days in a row. That to me was just a clear buying opportunity, massively oversold, and you know the rest of that story. So where are we now? We've come back to the minus 5% area. So again, this is an area where if you're looking to be long in December, for the best 6 months of the year, third year of a presidential term, all the good news that we should have going into Q1 of 2015 with interest rates low, the economy strong, and earnings strong. This is where you want to be buying stocks right now. Not saying that the S&P can't go below 1950, but but you want to be buying right here, you know, taking your first stabs at many longs, and that's what we're doing. All right, one more positive look at things. The McClellan oscillator on the NYSE, the NYMO for short, back in oversold territory here. And we've actually exceeded the levels we saw in October. So we're, you know, punching through minus 80 here. Another buy signal. And, you know, so you put all these things together and you want to find, if you have a fundamental case to buy stocks, you go to the charts, you find out what's weak, what's strong, you know, what the potential is of a further slide. And yeah, so we could find out later this week that a couple of hedge funds might be shutting their doors because of this emerging markets and energy sort of perfect storm, you know, that's affecting Russia, affecting Brazil, affecting Mexico, and it's going to affect other countries. So you know there's going to be some hedge fund pain out there. Many investors are just waiting to find out how bad it's going to get. We've got an options expiration this week. This week could actually mark some sort of capitulation lows, and you want to be looking for your opportunity to get long. All right, thanks for joining me in the kitchen, and we'll see you next week.